to record. Welcome, welcome, welcome. Thank you all so much for joining tonight. We have a very special guest on. One of our expert lenders are in the house tonight. Many of you may have heard of her or know her already. I'm actually not going to introduce her. I'm going to leave that to my partner, Jared. But I am going to introduce myself. My name is Tiffany Spann. I am actually the partner and co-founder of Crown Capital. A little bit about myself. I started off in the single family space. I always wanted to do multifamily and I didn't know exactly how to started up a coaching program. I actually met Julie while I was in that program, our guest tonight. And I met actually my partners, some form or fashion from that program, which is really crazy. But once I learned about the power of apartment investing, I started selling off my single families and smaller multis that I had, and I pivoted towards multifamily, and I've fallen in love with it. It's a passion of mine. And yeah, I'm here tonight to share with you the impact of interest rates, how they are all rising, and on us, how we're going to be impacted as investors, whether it's on the passive side or the investing side. But enough about me. I'm going to go ahead and turn it on over to Noel.
Hey, everybody. I love it. I love it. Thank you, Tiffany. I'm so excited for all of you to be here this evening. You're in for a real good treat. Julie is amazing. She's actually one of the first people I have met getting into the multifamily sector. I just kind of DM'd her in LinkedIn and she answered, which was, I'll forever be grateful for that. I don't even know she knows that. So you guys are in for a real good treat tonight. A little about myself. I'm a former pro athlete turned scientist and now a multi-family enthusiast. And I'm just so excited for all of you to be here. Jared, take it away.
Tiffany, can you mute all the participants, by the way? I don't actually have access to that. Thanks. I am Jared Ash. I am our investor guru. So my role and responsibility with Crown Capital is to make sure I talk to everybody who's going to invest in one of our projects. You may know one of our other partners, but my job is to build a long-term relationship and understand your financial goals and be here to be your resource and be your communications point. So that's a little bit about my responsibility, my background. And OS is Tiffany, I don't know if you could mute. Yeah, thanks, whoever that is. My background here is I live in the San Francisco Bay Area. I'm the father of 3 people. I actually come from the government affairs space where my expertise is building relationships and managing them long-term with people. I started, like a lot of other people here, in the single family space, still own a couple of homes in the Memphis area. And the homes that I have, the cash flow is 18 cents above my property tax bill on my primary residence. So it's nice. I know exactly what my ROI is and how I benefit from it, bill to bill every month. And I'll introduce Julie in a little bit and talk more about our relationship. Lupe?
Hey, good evening, everybody, and welcome to our webinar. I'm Lupe Chow, and my background is I'm in the military, active duty Navy, and I started in real estate just about 4 years ago. Very similar path to Tiffany. Started out in single family residential, but once I realized the power of multifamily, I never looked back again. I know Julie very well. I've talked to her multiple times on various lending situations. Julie, I know we haven't had a project yet, but I'm still looking forward to it, continue working on it. So hopefully to partner with you one day. For my military friends that on the call today, one thing it was so eye-opening for me is, for us to serve and sacrifice so much for, to serve this country and do whatever you do. Take the time to really educate yourself, learn about passive income, learn about building wealth, because these are the things that's really gonna, really benefit you in the long term, even after the military life. So I'm really passionate about it. Please connect with me. I love to talk to you about it and share more about what I do. Thank you all for coming.
Thanks, Lupe. Jared, we want to go ahead and pass it back over to you. If you could please introduce the lady of the hour.
Yeah, the queen of lending here. So I'm not going to read Julianne Peterson's bio. It's up on the screen and she could tell you more about that. I'm going to tell you, and you've heard a theme from all my partners. I've known you for 2.5 years. You're one of the first people I met in this space, I think through a Michael Blanc investor program and mentorship group. And you've mentored me. I think we've been on the phone every week, every other week. We've talked for maybe that's 110 weeks altogether, 120 weeks altogether. And we've done a project together. Two actually, that you were not only a general partner,
hardware
but that
other people. It's just hardware everywhere.
Andrew, can you mute
You should
Andrew?
get a task raptor. Yeah. Oh, also, was able to fire up
Can you
the
mute
NAS
him, Tiffany? I don't know if you have control.
over at over at Ontario. It went from
All right, I'm gonna try to talk over him.
Winona.
And so I just,
And
I'm
then,
looking
I've
for him. Hold on
invested
one second,
in
Jared.
NAS from the
deals
Activision
with
stuff
Julie,
that
so
was
she
dead.
hasn't
It looks like
been
it's
just a
alive
lender,
in
but she's
some manner
been
now,
my general
but
partner
not recognizing the tries. But
on those deals, and she's been great to get her perspective as not only a lender, but somebody who's put in money on a deal, and she's helped
Old
coach those
capital.
deals and lead those teams. And that's been very helpful. And I really appreciate her perspective on the multifamily market. So Julie, do you want to take it away? And sorry if I butchered that, as I'm hearing all the participants.
Okay, perfect. Thank you so much. I am so thrilled to be here tonight. And you know, that is the greatest thing that I did on my Zoom at 8. I have everybody come in muted because that happens all the time. So it is tough. I want to welcome everybody to tonight's gathering. I appreciate you taking time out of your day to go over what the heck is going on in multifamily financing. I do have a couple questions. Now, Jared, you were going to kind of put together a questionnaire. Did you do that for us? You're on mute.
Now I'm on mute. I'm trying to put up the polls right now. But I do not have the host access still, Tiffany. So I will have Tiffany put up the polls in a minute. Give us a minute on the technical details.
Okay. So you know, again, about me, I've been in business. I've been in real estate for over 30 years. Actually, I was 22 when I bought my first house. I said, I am not going to pay someone else money to live. So I quickly put a bunch of money together, bought my first house, lost $80,000. The riots in Los Angeles came and just, you know, killed my business. I ended up giving my house over to somebody for $4,000 and continue to pay off some of the loan on that. Went to the Bay Area and doubled our money. So my point in telling you that is it's good, it can be great, and it can be bad. So take what you learn on all of the platforms that you tune into. Take a little bit of it, check it out, try it out, see if it fits for you. This is, you can make big money, you can lose big money, and we are in a kind of a crazy time right now, not knowing what's going to happen over the next couple years, really. We've seen today they increased the rates another 75 bips. So before we get started, I do want to go over just a little bit about my company. So I want to share what oh wait, so are you going to take the poll first? You got
so
that?
my apologies, my inept on Zoom. Tiffany said I needed to submit it in advance. I wrote it out on my computer, not in the Zoom, but I'm going to ask the group.
Okay.
So our question for the group is, are you, regarding interest rates, are you one, and please answer in the chat, just chime in. We'll be able to read it and share it. One, are you most concerned about a deal you have now and how the fluctuating interest rates impact a deal you are in now? Two,
As
are
a
you,
passive investor.
as a passive investor? Number two, are you holding back your investment capital to see where the market goes related to those interest rates? Or three, you're just really confused and you're here today to learn more about how this just impacts the world in general.
Go ahead
All
and
right,
make
we
that
got some
decision.
people holding
Oh,
back,
okay.
some people holding back and learning. Tiffany's concerned about how it affects the deal now.
Yeah.
Charlie's, yeah, concerned about the future, holding back, and about deals now. Okay.
Okay, here to learn. Maxine, great. All right, good. I'm glad to see kind of where you're at. So what I see is most of the people are trying to figure out what's going on. Here to learn. Glad I could be of help to you tonight. Do I have the ability to share? Yes, I do. All right, so let me pull up my screen. Hang tight. Okay. See. Share screen. There it is. Share. And here we go. So do we have that open up like that? There we go. Oh, everybody see my beautiful picture? Oh, no?
I just
For
see
me?
that you've started sharing a screen. You haven't selected what screen you're sharing it to.
Hmm. So I do show it. And it's saying Zoom quit unexpectedly. Sure.
You there? You're
We may
you're
have
on mute.
we may have lost her.
Yeah, no, it kicked me off of Zoom. So let me try that again. Let me try. I'm showing that I'm sharing it. So let's try that again. Otherwise, we'll just do our best and forget the rest. Share screen. Here's this sharing. And do you see my screen? Okay,
Yes.
perfect. Okay, good. All right. Well, so a little bit about me. So it's all about me. No, just kidding. All right. So Old Capital, we are a nationwide broker. So we've been in business for 36, almost 37 years. And what that brings to you is the knowledge of what's going on. How do we get these deals done? There's a lot of people who've come into the market that say, hey, it's a commodity. I'll do it. They put out quotes and they say, I'll get it to you for 5% and I'm at 6%. And that puts me at a disadvantage. Well, we know that it's going to be at 6%, but you say, oh, this guy is at 5%. So I'm going with my business with him. And at the end of the, 3 days before your closing, you told all of your investors that you are going to be owning 1% share of the deal because they brought in their capital, and you have to go back to them because that lender or that broker came in and said, oh, by the way, I can't get you 5%. I can only get you 6%. So that's why we vet the deal. We know these lenders. We understand how to put these deals together. And that's a lot of value for you. We have execution certainty. You're putting your reputation, your money on the line. You want to make sure you're working with specialists. It's just like, why would you go get your plastic surgery done with the cheapest guy in town, right? This is a relationship business. You want to do business with the people that you know, like, and trust. So, let's start today meeting each other and understanding what it is that lenders do, what brokers, how we can help you. We're working on behalf of you. We've closed 6,500 loans. That's a lot of loans. In 1 year, we'll close over $1 billion, 1.2, 1.5. And there are some lenders, again, I'm a broker, some lenders that lend out less than what we do. So we are looked at as real experts in this area. You want to work with, people that you want to do business with, that make you happy, right? Because we are your biggest partner. We can, make your deal go well, or we can make it go bad. So make sure that you like doing business with us, and that we are a true partnership. Okay. Myself, again, I'm 30 years in this business. I am a lender. So actually, again, I'm a broker, but we call ourselves lenders. I'm a general partner on deals. Was in single family. So I've been in a lot of the same shoes that you've been in. I've invested a couple $1 million in limited partners deals. I'm a capital raiser. I didn't know I had this power, and I am the host of Zoom at 8. So if you haven't seen that or heard of it, look it up on Zoom at 8, Google it. It's a great little Tuesday nights, every Tuesday night, come join us. So what makes us special is that we are impacting others. You talk to other lenders or brokers, they're just looking to make a deal. We want to build our business, not just one and done. We want to really set the stage for our relationship. So how do we do that? Again, Zoom at 8 separates me from the others. We also do the Old Capital podcast, which has been out for many, many years. I know somebody reached out and said that they hear James Zhang. James Zhang is one of my colleagues. He puts out a monthly or a quarterly update. Look at it for that on his YouTube channel. You can look at my YouTube channel, Julianne Peterson, for our interviews. And then we just completed our Old Capital conference. It was in Dallas. It is one of the best. It's not trying to sell you anything. It's really updating you on the market and what's happening with brokerages, with property management, with interest rates. So if you're thinking about what am I going to do next year, make sure you sign up for it. Old Capital podcast or Old Capital conference. All right, so let's get into this, because things are moving and shifting. As you know, they raised another 75 bips today. Okay, that's the Fed funds. That's your SOFR. That's your short-term lending. Okay, if you look at this chart, back at the beginning of the year, it was 0.08 in January. Okay, so the way that we work this is it's the index plus a spread. So last year, the beginning of the year, we were at 0.08 plus about 300. So your rate was, we actually had a floor at 0.25. So you've got 0.25 plus 300 or 350. So in January, we were doing loans on bridge at 325, 350. Okay, look at today. Today is at 2.33. That's a huge, huge increase. Okay, look at the guy. He's lost all of his hair. It is on the rise, and it's going to continue. So if you were thinking about buying something tomorrow, I recommend you buy it today. If you didn't buy it yesterday, today is the best day. We just don't know what's going to happen tomorrow. I would tell you that the rates will be going up tomorrow. And what happens with rates going up tomorrow? The pricing has to go down. The pricing of these assets have to go down. Okay. And it's taken a little while, and we're still trying to figure out, are these sellers going to buy into the idea that nobody's going to buy your asset at the price that you thought it was 10 months ago? Those days are over, at least for now. Okay, so let's talk about bridge financing. Okay, in COVID, when many of you jumped into multifamily, why? Well, you were sitting at your desk, you had lots and lots of time open. You're like, hey, I need something to do. I'm sure some of you could say that, right? Maybe Jared, I don't know. But this is when so many people jumped in and started learning. And the debt at the time was right at bridge lending. It was like 0.05. It was amazing. We could be doing deals at 3%. We even got below at 2.5. I think I even saw 1.9 at one point. So bridge financing really was an opening for so many people who didn't have money. So let's talk about what is bridge. Why bridge? So bridge is just that. It's bridging from one side of the water to the other. Okay, it's getting this asset that is not stabilized. Stabilized is whether it's raising the rents or doing the capex expense, all the renovations. It's taking it from that, maybe it's low occupancy, taking it from that, using a bunch of money that's thrown into the loan, okay, doing those renovations and then getting out either on a sale or rent, and then or going into stabilized agency lending. Okay, what bridge lending allowed people to do is who people didn't have any money. A lot of people didn't have any money in these deals. They were able to buy a $20 million deal, throw in another $5 million, you're at 25 million, you get a $75 million 75% loan on that, and you brought in very little. You maybe called up some of your friends, you maybe called up a couple capital raisers, and you closed, and you're down the road. But you never thought, oh my goodness, do I need a rate cap? Nobody talked about a rate cap. Nope, nobody did. Back 36 months ago, never heard of a rate cap, didn't need that. So you're often doing this. COVID's open, we're working, we're seeing how great life is. And now you're getting your mortgage statement and it's going up and it's going up and it's going up. And all of your cash flow is going to paying your mortgage. And you're getting phone calls. Hey, where's my distribution? Well, sorry, Mr. Investor, my distribution, your distribution, it's not coming this month. It might be next month. What a lot of people have done now is they're working on capital preservation because we do not know how long this SOFR is going to go, how far it's going to go. And by the way, we had he's not an economist, but he's with a rate cap company. He understands interest rates. He told us we'll be at 4.5 on this index by Christmas. Okay. So think about that. If these guys are in those bridge loans that they jumped into 18 months ago with no rate caps, and we'll cover what rate caps are, they're going to have a hard time because that comes due every month. And we are not done with the capital improvements or the CapEx project. Okay. So we're starting to hear, hey, Mr. Investor, I need some money. I need you to give me a loan. I need some more capital. It's called a capital call. In fact, I got a phone call yesterday. We need a bridge to a bridge loan. And my lenders are saying, I'm not doing that. I'm not doing that. And these operators are ready to give back the property to the bank. This is the start of it, guys. You got to be really concerned about if you are in a deal right now with bridge lending, I'd start asking questions. First, I would be asking, do you have a rate cap? Did we buy a rate cap on this deal? So let's talk about that. Okay, a rate cap is a insurance policy. It's like just like you buy for your car, you have a deductible. We call that a strike price, let's call it, okay? So a deductible, you have a $250 deductible, 500,000, whatever it is. So in a rate cap, you have a 1%, 2%, 2.5%, 3%, 3.5%. And you have a rate cap that will be for 2 years, it'll be for 3 years, 4, 5 years. So a lot of these lenders didn't ask for one. Then they said, oh, I need one. We need to get you one. And as the stock market went down, bonds went up. And these are tied to the bond market. So what cost you maybe 24 months ago may have cost you 200,000 for a 2% deductible, if you will. We call it a strike, is now 500,000. It has doubled. And so people are like, okay, so how does this work? You buy this rate cap, you put, let's say 2% strike on it. We bought this loan at 4%. They're going to cover, you have to cover the mortgage from 4, 5, and 6%. Okay. We're already past 6%, my friends. Okay. So that rate cap policy, insurance policy, once it goes over 6%, they're going to pay you the different, they're going to, for how much it goes over that policy, that 2%, they'll pay you. And then you would pay the bank. But a lot of people didn't take into consideration that 2%. Again, if you didn't buy a cap, you are running out of money. So check into that. If you're a passive investor, call up that syndicator and say, where are we at with this? What is our coverage? Okay.
So Julie, it's Jared, I'm gonna chime in because you and I
Yep.
had talked about, let's make this a little bit of a conversation piece
Sure.
versus you just talking. So first, I love this picture. I was there that morning you took it. I was doing the Sydney Harbor Bridge climb that day. So I'm up there to the left, just out of the view of the camera. Second, hitting this rate cap and why that's important and why I'm chiming in with the start of the conversation is on our Houston deal, where both you and I, you're not only the lender, but you're also a general partner, as am I, as is Tiffany. We have that. So can you talk about how that is helping us in that case? And then in the other case, I was in a conversation today with some friends, and they pretty much said they are going to run out of money. They didn't even know when they were going to run out of money. They just knew they were going to run out of money soon because they expected to be down at least another couple 20, 30 grand with today's announcement because they did not have a rate cap. So can you sort of talk through maybe our Houston deal and how it's helping,
Sure.
and then how people are losing money on that other deal?
Yeah. So we bought a rate cap and we had a step up approach. It saved us a little bit of money. You could go all in for 2%. You could go in for all at 3%. The less the strike price is, the higher the strike price, the less expensive it is. But that means you have to pay more money on the mortgage. So our loan is 4%. Okay. We took for the first year, we took out a 1.5% strike. So that means we have to cover our mortgage at 5.5. Okay. Today's rates are about 650. Okay. So they're going to pay us 1%, whatever 1% is, right? Because 550 versus 650, they're going to pay us that amount, and we're going to make that payment to the bank. But all we are responsible for at this time is an interest rate at 5.5. Now, we have that for 1 year. Most of these rate caps are 2 year and sometimes 3. We bought a 3-year rate cap, which I think was smart. The second year, which is going to start January, I think 3rd or 8th, is going to be 2%. Okay. We bought it at 4. It can go to 6. Today we're at 650. So December 3rd, we're going to have to pay from 550 to 6. So we've got a little bit of an increase. And then it's going to be reimbursed that increase over the strike price. Okay. Is everybody following me? Yes. Okay. We
Yeah.
have that for 1 year. Okay. Third year, again, most people took it out for 2. So what are they doing? They're actually having to put money in escrow for that third year of a bridge loan, for that, I'm sorry, that third year of a rate cap. We've got the third year. Third year is 2.5 for us. So again, we started at 4, we'll be at 650. Now, hopefully in year 3, rates will be coming down, and I'm going to show you some of that here coming up. But we will have to cover our loan up to 6.5 come third year. Now, we may be able to get out before that third year kicks in, but we have that as an insurance policy. Now, these people who did not take out their
Julie, before
Yeah.
you get into that part of it, what
Yeah.
does that 1% or more on that deal mean? What does that rate cap actually, what's that 1% equal in dollar value for everybody?
1%, or what do you mean by what do
The
you mean by
rate
that?
cap is saving how much money per month?
Well, it depends on, you mean for reimbursement?
Yeah, how much are they
Well, I
covering
mean,
for us in reimbursement?
it would depend on, how much loan they took out, right? So I think, I've seen anywhere from people that have taken out, their mortgage was 15,000 a month and it's now 35,000 a month. I mean, it is significant. I've seen one that was 37 and now it's 62. And I've heard there was one that was 57 and now it's 200 who didn't have a rate cap on it. Okay. And people,
Right. So
new people.
that's important. And hopefully somebody said they couldn't see my face so well. Hopefully I've improved the view of me. That's important because you're talking somewhere between $30,000 and $200,000 or $150,000 monthly for those that have a rate cap or don't have a bridge loan. And other people could be losing a significant amount of money in their deal. So I know with us in Houston, we were prepared for it. And we factored that in. I know on our deals with Crown Capital in Louisville and Lubbock coming up, that those are fixed rate loans.
Yeah.
But we're talking about the bridge, and a lot of investors, like the one we're about to talk about, are losing probably 150,000 a month.
Yeah, this is true. And, in this case, this person that called me up, they actually had a property manager as the general partner, which I fully, vet and think that's a great idea, great structure, as long as they are a proven partner. But that didn't go over so well. And so they want to remove them and put somebody new in. And so that changes the whole structure. You're talking about an entity structure. They want to keep the entity. It's called a recapitalization. A lot of banks don't want to do that, even if there wasn't the situation that we're in. Just trying to pull people out and put people in is complicated, and not a lot of people buy into that idea. But this group, they didn't have a rate cap. They were not able to get bad people out through COVID, and their economic vacancy has just deteriorated over month after month after month. So, that's just a symptom of what's going on. And I really think that over the next 12 to 18 months, there's going to be a lot of openings, a lot of opportunities for people like you and I to look at deals that are really suffering. And it's very, very unfortunate that people are losing, that could potentially lose money. We don't want to see anybody lose money. And, I always say this is the long game. Take your time, go slow. A lot of people were on the fast. They were on the run over the last 2 or 3 years. And a lot of people made a lot of money. But things have changed. We did a retrade on a recent deal in San Antonio. It was $40 million. We were putting bridge on it. The interest rates dropped. The value couldn't hold the value, couldn't have the returns. Went to the seller, asked for a $5 million retrade, and they said no. It didn't work. They said, we'll do 37. We said, no, it doesn't work at 37. He said, sorry, give me your money. It's mine. So we lost quite a bit of money on that. I'd rather lose money today and not hurt my relationships with my investors. That's the risk you take. So, hey, what is the future of bridge financing? I don't know. I think we're seeing a lot of changes right now on adjustable bridge financing. People are still doing it. They're, the big guys, the people that have been doing this for a long time will do the bridge financing. And I think, they've been doing it long enough. They've got a track record. I think that's fine. We're seeing, like, my top product right now is fixed bridge. It's a great product. Now you're going to talk about 7.50, 7% to 7.5%. But you're going to hold on to that for 2 to 3 years and you're going to get out. You're going to have to decide, can I get the NOI up enough to be able to then transfer into an agency loan? You can buy it today, but if you can't get into the next loan, like you don't have the right partners, that's what we do. We have to vet you. We have to make sure, hey, who's on your team today? Will they be able to qualify you for an agency loan? You have to know what your business plan is going forward. So that's bridge financing. I think there is a future, especially in fixed bridge. Be very, very cautious if you're getting into a deal where the syndicator's using bridge. I think if they're been around for 10 years, I would think you're going to be fine. Now, let's move forward and talk about the 10-year treasury. This is what we saw. We've seen some huge changes in this. This is just over the last year. Okay. You can see it's elevated tremendously. We are now at the top. It just came down today. This was yesterday. It came down to 353. So when we talk about rates today, we're looking at 353 plus a spread. We take the index plus the spread. Today, the spread's around 175 to 200. So you're looking at rates about 525, 625, something like that. Now it depends on the location. It depends on, are you using yield maintenance or step down prepayment? We can go into that, but that's, a little bit deeper. And who is in the ownership? Who has the experience? Do they have experience here? Do they have experience in another market? All of that is taken into consideration for the interest rate. Okay. So if we talk about agency. Okay. So you're talking about Fannie and Freddie. Fannie is going to be either small balance up to 6 million. We start at 1 million, go to 6. Freddie is going to start again at 1 million, go to 7.5. Here's the difference. And here too, when you're getting into a loan with a syndicator, ask, is it a Freddie or a Fannie? If it's Freddie, it locks the day you sign that app. So you got to figure out, okay, we don't have any risk. This will be good. Can't go up. And now it might go up a little if the operations change, but for the most part, it's going to be pretty set. Okay. Fannie, it fluctuates. So some of these deals that people got into, and I'm in a deal right now, one of my clients, we were at 2.78. Okay. We're at now 3.53 today, right? That's almost 75 points, right? Okay. Plus the spread. Now the value of their asset just went down. And that just happened over a less than a 60-day period. So they're questioning, do I need to go back? Is this a material change that I need to go back and tell the seller, I want to buy this? There's a change in index and the interest rate, and I need to retrade this.
So Julie,
Potentially.
I want to bring in, to keep it as a partial conversation
Yeah.
here, I want to bring in Lupe, who wants to add to the dialogue here, my partner.
Absolutely.
Hey, Julie, no, I just noticed we have some questions. So
Yes.
you wanna, okay, so let me go through the questions. The first one is from Nicole. She said, would that be a good acquisition strategy? Pulling list of loans pulled over the last year with no rate caps. What would be the filter requirement to pull a list like that? Do you understand the question?
Yes, I do.
Okay.
I don't know where you could get that list. That would be a great list. Absolutely.
I don't know if that's a public
Yeah, I don't think it is.
document. That would be, yeah, but it's a good idea, is figure
Yeah,
out
great.
who's got a cap, who doesn't have a cap, and let's acquire it. Well,
Yep.
I think to the point of the question is it creates opportunities. So Noel, who's at Crown Capital, our director of acquisition, he is out there having conversations not only with brokers, but Julie, and they've been talking about, like, hey, who's in trouble, right? The friend that I mentioned earlier today, they are in trouble. And I said, I am interested, if you hit that point where you are running out of money, come to me and let me try to buy your asset so you don't
Yeah.
lose your shirt, and we could restructure it with a long-term loan.
Yep. Exactly. Oh, and by the way, just a side note here, Nicole, if you come, and anybody else, come to Zoom at 8 next week. I have a person coming in from an escrow company, and they have a platform that you can sign up for, and you can find out whose loan is expiring. And so you can start making phone calls, and that might be a way to get a understanding of who might be, you call them up and just say, hey, do you have have a conversation at least, right? So that might be a way to figure that out. Zoom at 8 next week, Tuesday. Lupe?
All right, Julie, another question from Sarah. Anyone have some estimates on what kind of interest rate you are seeing these days, or where the rates are published?
Well, I
Julie
mean,
answered
yeah, I
that.
would say that, again, everything depends on the team, the location. So there's going to be a range. So on bridge, you're looking at, let's say 650, 6.5. It used to be 350. Now we're at 650. I think it's going to get to 7. I mean, my fixed bridge is already 750 to 8. And then agency is probably going to be, 525 to 650, somewhere around there, 675. Depends on if it's a, smaller deal, where it's located, if we're doing yield maintenance or step down. Yeah.
Hey, Julie, do you have a link for your Zoom at 8 sign up? I know we have some questions about how to sign up, where to find this meeting. Have a link you can drop.
If you go on Facebook, or you just even Google it, you can do Zoom at at 8. It'll come up with the registration. It's on the left-hand side of the Facebook page. It's right there. Sign up, and then we'll send you an email with a password. Don't forget the password. That keeps the crazies out. And then come on Tuesday nights.
I think somebody just posted it. Thanks.
Oh, thank you so much. Appreciate that. Awesome.
And then somebody else was, Sally was just asking, if we move to a massive labor set of layoffs in the next 2 years with a recession, how does that impact multifamily? And I have my opinion on that, and I think it's good for multifamily, but I'll let you answer first, and then we'll dialogue.
Well, listen, my crystal ball is broken, and What I do know is this. We've got a ton of people that we need housing for. And housing is going to take 2 years to get the existing inventory that's already scheduled. It's going to take 2 years to get that. Okay, and that's going to take care of a third of it. So the drive, the demand for apartments is going to be there for quite some time. I don't believe that multifamily is going to go down in terms of it being a good place to put your money as an asset class to invest in. You have the tax benefits, right? And simply for tax purposes, and you don't have to do a darn thing. I love it. I mean, my husband said, I am done with single family. I'm hanging up that darn tool belt. No more weekends. We're done. I cried a little bit, and then I turned over it all to multifamily, and my weekends are mine and my taxes are mine in my pocket. So why wouldn't you want to invest in this? But do I think that we're going to continue to see the rates of rent growth be what it's been? I have a hard time believing that. I mean,
So,
we've had double-digit rent growth for for a strong year. We are not underwriting from a lending standpoint. We are not underwriting at 15 to 20%. We're minimally at 3, maybe 4. Okay. So you can write that in your underwriting model, but we're not going to allow that. It's really going to be less. If you can get more, great. But Fannie and Freddie were developed for simply the ability to take care of Americans, to give them housing. And we have to make sure that we are doing that. We don't want to put people out on the street. So we're going to continue to lend, and we're going to continue to provide resources for capital. But at some point, at what point do the American people say that's enough? And when does government say that's enough? I don't know. I think we've still got a couple years.
I look at it this way in terms of multifamily. One, everybody still needs a place to live. And in most major cities that are doing good, you have people who are still moving in and looking for a place. On the other side of it, as residential rates are going up, people who thought they were going to buy a house in 2022, 2023, 2025 might not be able to now, because the difference of, on $1 million house, let's just say, it at 1% is something like what, $1,000 extra per month, right? It is. $1 million is $1,000. So if you've gone from 3% to 7% roughly on the residential mortgage side, you're looking at, for a house that's $500,000, you're still looking at $2,000+ increase in your monthly payments. That's going to force people to keep staying in multifamily and keep renting, particularly in any of the major or secondary markets. And that creates opportunity for multifamily. But I'm with Julie. I think Noelle and I had talked about this recently. The broker was telling us to project a 6 or 8% raise in rates, and we wouldn't do it. We passed on the deal because we couldn't underwrite it based on that. We could only underwrite it at a 3% rent raise.
Yep. Any other questions, Lupe?
I think we covered all the questions so far, but feel free to drop questions. If you have any, we'll definitely cover that at some point.
Okay. So this is a really interesting piece here. So SOFR again is your Fed funds versus your 10-year treasury. Okay. So today we went up. We're at 3.5. October 22. They're going up higher. They even went up higher than we anticipated just over the last couple of weeks. But you can see that SOFR rate is going to go up almost to 4.5, and it's going to level off. And you can see it's going to start to, again, this is speculation, but we're going to see a huge dip. It's going to be slower, but I think by, looking at this by 2027, you're going to be at the low, lower than what they are today. So what does that mean to you when you're investing in these, or if you're looking to purchase something? Okay, you could still do bridge and you could put a rate cap on it, but I wouldn't go with that 1 or 2% strike, because we know it's going to go up at least a 1.5. But if you buy it for 2 years, I think, we're in October right now, we're almost there. In October 23, it's already stepped down. So you may be overpaying for coverage that doesn't really help you. I just invested a couple $100,000 in a deal in outside of Austin, and we are doing a bridge, and we put 3.5 rate cap on that deal, because we know we're gonna be there for 2 or 3 years, but we don't, the rates are not going to be continuing to climb. That's what our hope is. That's what we're speculating. We did put the rate cap on, but we went for a little bit less expensive. These, again, they were at 200, they're now 500. If you back it out, what was 200 is now maybe 75 at 3.5, So I think this is an interesting view of what's going to go on over the next, this is 10 years. Again, it's speculation. We have a better look at the first 2 years than we do looking way out. If you look at the lighter blue, that's your 10-year treasury. And you can see that we're right. It's going to dip a little, which we've seen. It dipped a little bit. Now we're going up a little bit. It's going to come down, but then it's going to be on the rise. So if you have a deal where you need to get out in 3 years from a bridge loan, okay, if you follow your finger over to 3 years, you're in October 25, it could be potentially the same rate that we are today at 650 or at 520, 625, right? So maybe you underwrite it at 625 when you get out. Okay, cap rates are changing, they're going up, the values are coming down. So keeping this in mind is really helpful for what's, when you're looking at assets as a passive or as a general partner. Whoops, hold on. This is what happened overall. This is happening over the last 10 years. Is it 10 years? No, it's more than that. Since 1982, look at the rates in 1982, huge. Now people say, oh my God, it's terrible. Not so much. I mean, look at that. We're still right about average. Okay. So I think the sky is not falling yet. I think over the next year, we're going to see things go up. But remember, we're going into a political year ahead. So what does that typically come with? Comes with everything is lower. So, I think this year is going to be, could be difficult. Okay, I love this. I think it's very helpful. Again, this is the long game. You put your money in, you let it work for you. Okay. So passive investors, it's not all doom and gloom. Okay, you have money in your pocket. Do not leave it there. What are you getting in your bank account? You getting even 1%? No. Get your money rolling. Inflation every minute is causing your money to lose its value. So get out of the stock market or move some of that money, diversify, whether it is crypto or you're going to buy into a gold mine or you're going to buy into gas and oil. Get it moving. Okay. And I have a deal right now that's a safe harbor. Is it good looking? No. But in 12 to 18 months, you're going to have 7% more in your pocket. Those are the deals that you want to be looking at. You don't want to be looking at, oh, 3 years down the road, I'm going to pay you, because you want to have money. You want to have some money coming in. Again, it depends on the business plan. It depends on what you want. Maybe getting in and getting out and having that risky works for you. Great. Okay. Tax advantages, we talked about preferred returns. If that's what you want, keep in mind preferred returns are going down. We used to see 10%. We saw 8. We're now at 6 and 7. Okay. But make sure that the people you're investing in have a track record. Hang your hat on somebody that can say, here is what I did. This is where I'm going. Those are the people you want to invest in. Again, there's a shortage of housing we talked about. This rental increase is going to continue, and the opportunities are going to continue with the bridge issues, if you will. And when you're ready to roll, get that money going, move it. Okay. Again, I don't have a crystal ball. For you general partners, keep looking at deals. Move through them fast. Do they work? Do they not? And I would, if you put in an LOI and you don't win it, check back. We're seeing a lot of stuff fall out. I mean, a lot. Some days I have 5 deals on my desk, all accepted LOIs, and the next day I got 2. So keep checking in with those brokers, those sellers, okay? Always be selective with your partners. Do a background check. Again, this is the long game. Know how they look at what is right and what is wrong, what is legal and what is illegal. Know what you can push. The SEC does not work in gray areas. It's right or wrong. It's on or off. It's black or white. Know that, okay? You want to validate the rents. Again, we're not seeing these 15% increases, and a lot of the lenders will walk away from that, okay? We are seeing on agency a little bit better leverage. We used to see 50 to 60 because the prices were so high, but now we're seeing more of 65 as average, maybe even 70, because the prices are starting to come down. Keep in mind when you're talking to your clients, to your investors, I need to hold back some capital because I want to make sure if something goes wrong, I have capital. Okay. There are assumptions out there that have very good rates. We just came from a very low environment. See if those are out there. Look at those failed bridge loans or deals. Find out what your investors want. Do they want long-term? Do they want short-term? Today's prices are going to be better than tomorrow's. All right. Any questions? I got it right at 5 at my time, 8 o'clock your time. My, oh my.
Yeah, Lupe, do we have any other immediate questions or any comments you have?
We have a question from Lupe Chow. That's somebody using my login, but no problem. What are we seeing with investors being able to capture deals through seller financing? So Julie, I think he's asking or she's asking if investors are doing seller financing and how this whole lending piece will, play into the deal structure.
Yeah, it is happening. So hold on just a second before I answer that. I'm going to turn this off. So if you want to take my contact information, take a picture of it. 3, 2, 1. Okay, perfect. Seller financing is great. It's a great option. A lot of big lenders like agency don't want, they want to be in first position. Now, why would a seller want to be in second position? I don't think they want to do that because they're going to lose their asset if the bank comes and takes it. So you got to be careful. We know a very young investor who does only seller financing, and he's doing a killer job. So it's out there. have the conversations. Some of these older investors, they just want to have income coming in. It's a great way. Offer them what's happening in the banks. It can be very lucrative for both sides. Otherwise, what I've also seen happen is you have them come back in. You have the sellers come back in. You pay them off. They come in as a general partner or as a limited partner, either one. They can have their own class. I've seen it where they do not get the cost segregation, the bonus depreciation. So that goes towards more of the investors' money. So there's ways to be creative, but there's not a lot of creativity in commercial lending. Okay, it's fairly black and white. But like some of the agencies now will also allow preferred equity to also come in. And then you could have, instead of you bringing in 25 or 35%, you would bring in 10%. But listen, a lot of these preferred equity partners are no longer bringing in 85% of that, let's say 35%. They're saying, I'm not 85, maybe I'll give you 60 or 70. There are, that does help you if you're short on cash, but they're pulling back, just like everybody. We just don't know what could happen. People are preserving their capital. Anybody else?
Well, I think as we'll wait and see if we have one more question. I know it's time, so I want to keep everybody on time. Noelle, Tiffany, Lupe, if you want to weigh in anything, I think one of the keys here is multifamily can be good investments going forward if you structure your loans properly.
Yes.
And you plan ahead for the bad part. I also hear in this, is trying to sum up what I've heard, Julie, is there could be buying opportunities in the near future for people who did not structure bridge loans appropriately and are going to run in trouble and might need to sell quickly. And I am hearing that it could still be a good multifamily is still a good investment because people still need a place to live and there is a housing shortage. And then multifamily investing is good because there are tax benefits to it for passive investors. So that's sort of my summary of a couple of bullets that I took away. I don't know if for Noelle, if any way.
I think the important thing to keep in mind is that it's a long-term thing. Like Julie mentioned multiple times during this call, right? I think people may have the idea that you're gonna get rich quickly in real estate, but that is sometimes the case. I think we do see that people did really good deal, did very well, but I think generally speaking, it is a long-term game and we are here for the long haul. So that's just a perspective to keep in mind, not a get rich quickly scheme.
Yeah, I do want to address that. I get people that are in these education programs and they have never done anything. And they bring me a $38 million deal. And hey, this is a free country, but my question to you is, how are you going to capital raise that? Have you ever capital raised? Are you going to get lending? Do you have a relationship with a sponsor? Do they have the ability, do you or they have the ability to bring in maybe 8 or 10 million or 12 or 14? When you're doing this, it's stepping stones. Last night I had on Zoom at 8 a guys who started at 38 units and now they're up to $67 million deals. It took them 10 years. Okay. So it is a process. It's slow, but you have to take the steps. Don't jump up here yet. Go slow and do it the right way.
If we don't have any more questions, can I please request for those you can turn your camera on because I like to take a picture and this will be posted on our website and linking to show we had a great webinar. So let me count 2, 3. Okay, 1. Thank you, Nicole. I see your pretty face. Thank you, guys. 1, 2, 3. Okay, and one more on the second page. 1, 2, 3. Great.
Tiffany, I saw you.
I saw you doing your fingers, Julie.
Oh,
All right.
Well, you guys, thank you so much. I appreciate it. You're all very important to me. I love our relationship, and that again, it is all about relationships. So if I can help any of you at any point in your education or in processing this information, please reach out to me. 2 things: get educated, and 2, invest in a limited partnership. That's most important, so you can progress through this. That's all I got, you guys.
Thank
All
you,
right.
Thank you so
Julie.
much.
Thank
Thank
you,
you,
everyone.
everybody.
Have a good
coming.
night, and please be in touch. Bye.
Thank you. Bye.
Good night.
Good night.